My turn to do my self-introduction. So for those of you who don't know me, my name is Jackie Clements. I am a former county auditor in Tipton County and Clinton County. I'm a former state rep, and I've also been working for the Association of Indiana Counties now for about 18 months. I call it my retirement job because it allows me to do the things that I like to do best, and that's working with all of you in getting best practices out there in your counties and educating you on those best practices. I've been scurrying out there for the next PowerPoint, so excuse me as I'm a little flustered. Okay, so today I'm going to talk to you a little bit about budgets, revenue streams, and those wonderful things that claims that can be so frustrating for all of us. And are we not working? On. Advance. Oh. So in the early days, the Dillon Rule was a concept that stated that courts viewed local governments as an extension of the state, and you were only allowed to do those things that the state statutes allowed you to do, authorized you to do, either by the Constitution or the General Assembly. But in 1980, Home Rule was adopted by our Indiana legislature, and that gives you the power to do those things that are set in statute, and also gives you authorities back at the local level to be able to conduct your affairs the best way at your community, as we have all changed in size and urban to rural. And so that took place and is known as the Home Rule in 1980. You've heard this a little bit, and I'm going to speak on it very briefly, but often as I travel out through the state, people don't know which agency to contact. And I think they talked to you early about this, but I've kind of listed it here. And it's kind of an easy thing that I put in my mind very early is if it has to do with property taxes in any way, it's the local department, it's the Department of Local Government Finance, the DLGF, and if it has to do with your finances and the payment of claims, it's the State Board of Accounts. And those are kind of the two easy ways, because often some of those things overlap a little bit when you talk about budgets, but budgets are funded by property taxes, so that throws you to the Department of Local Government Finance. So if property taxes are involved, that's kind of that key that tells you go there. Otherwise, you go to the Board of Accounts. Government responsibilities, you all pretty much know what your responsibilities are, but here's a simple list of those responsibilities that are set out there that as local units of government, we are to provide for our citizens in our community. And now I'm going to get into some budget terms, and these are terms that as you work with different field reps at the Department of Local Government Finance, or you're talking between the offices, it's really important that you know kind of the difference. There are a lot of items that are the same or close to the same, like a taxing unit and a taxing district, and people get confused with that. And you can remember that the taxing unit is that unit that actually establishes a rate. The taxing district is a combination of those units that make an entire rate that the taxpayer is going to pay on their property taxes. The levy is the amount of taxes to be collected, and you often hear talked about the maximum levy. Back in 1973, Governor Bowen froze the levies, and we've been working under a frozen levy since that time. That limits the counties the amount of money that they can increase in collection each year. And that amount of increase is known as the growth quotient, which is a 6-year non-farm income in the average out there. Net assessed value are those gross assessments less all of the deductions that are available, deductions and exemptions. And those are the values that you use when you determine your tax rates at budget time. The different types of reductions that we have to the assessed values are, and there is a difference between deductions and exemptions. Deductions are those mortgage, veteran, age, disability, and exemptions are those charitable and religious type of exemptions. The deductions are usually handled by the auditor's office, and exemptions are handled by the county assessor's office. We also have tax abatements and TIF, and on the largest deductions that we have are the homestead deduction, which is $45,000 or 1/2 of your assessed value, whichever is less. And if you have a homestead deduction, you're entitled then to the supplemental homestead, which is 35% of the remaining assessed value after the 45 or the half is removed from your value. And I will preface it here. If anybody has any questions, please raise your hand as we're going along. I don't mind answering questions as we're going along. So we have a levy-controlled fund. We have different types of funds out there. Levy-controlled funds are those that are controlled by the levy. In other words, we take that levy and divide it out by the assessed value, and that gives us our rate. Or we have a rate control fund, and those are often known as CUME funds. And cumulative funds are those that a rate is established by usually the Board of Commissioners, but the CCD is done by the County Council, and those rates are set, and that rate then is calculated against the net assessed value to determine the levy in that. Now that rate may vary just a little bit each year, depending, there is a work formula, but it stays pretty consistent on the amount of money that you're allowed to collect in a rate-controlled fund. The debt service funds are those funds determined by the principal and interest that is due on a debt in any given year, and possibly an assessment fee or a maintenance fee, and you can only collect that amount, and in new debt only an additional 15%. That is all that you're allowed to collect on those debt funds. You can't collect ahead and store ahead. Appropriations are the amounts established by the County Council for expenditures. We have a current budget year, and you'll often hear me talk in this presentation about the current budget year. That's the year that we are in right now and spending from, and then we have an ensuing budget year, and that is always January 1st of the next year to December 31st. Our tax rate is actually taking the levy is determined by taking the levy times the net assessed value and then dividing that by 100, because our tax rates are on $100. The wonderful property tax caps, we have the 1%, 2%, and 3%. Those are the maximum amounts that a taxpayer can pay for their property, and that percentage is calculated against their gross assessed value, not their net. Circuit breakers are those dollars that we lose from those property tax caps, and the circuit breaker revenue or circuit breaker loss is never recovered. That is in fact money that is deducted from the taxpayer's bill, and you never recoup any of circuit breaker money. Those amounts are usually certified to counties by July 31st by the Department of Local Government Finance, and you'll watch those to make sure that you agree with those. There are many factors in determining those circuit breaker losses. So here we have a taxing district. And in a taxing district, and I kind of did this just so you can see how those units pile into a district. In this slide, we have 4 districts. We only have 4 districts. We have 4 townships. And so each one, all of these pay the county. The entire county rate goes everywhere throughout the county. And then in each of these townships, and I'm playing that I only have 1 school in my county. So everybody pays the school rate in this county. And then each of the districts, 1, 2, 3, and 4, will have their own unique rate, which then puts it into a total tax district. So then I've added a city, and that gives us a 5th tax district. So now, there in Township 1, the people who live within the city will pay the city rate, the county rate, the school rate, and the Township 1 rate. And here I've added one that shows a town that might set, or some other unit that might set between two different townships. And when they're in two different townships, because those townships have their own rate, they will then make up a different combination and they become a total different district. So in District 6, we have the county and the school because they pay everywhere. We have Township 3, and then we have Town A that compiles that District 6. But even though it's the same town, in District 7, it's the county, the school, the Township 4, and the Town A that compile that rate. So that's kind of the difference. It's that all of those little units, taxing units, compile into that taxing district. So every year we work on our annual budget. And the annual budget is a means for you to be able to spend your operating funds. It provides you the sources for infrastructure and equipment, but there are limits to the uses of the tax dollars. It's recommended that a policy statement be derived in your county to assist you in managing your local unit so that everybody is on the same plan and in the same direction. And then the budget is a summary of the appropriations that you're allowed to spend. And each fund will have their own summary and appropriations. So our budget calendar year refers to the schedule of events. And out on the DLGF website, there you can find a current budget or a previous budget calendar. We're finishing up in most of them because 1782 notices are going out and final budget orders are going out as they have to have them done by the 31st of December this year. But there is a lot of information in that budget calendar. The budget calendar is an assistance to all of the offices that are involved with the budget as to when the assessor needs to roll her values to the auditor must certify, and the dates that the different agencies at the state are going to be certifying values to us. So it's a wealth of knowledge in that. And you can go out and look at a former year. If you Google budget calendar Indiana, you can easily get to one. Forms that need to be completed each year in that budget process. And a new form that came out just a couple years ago is the pre-budget worksheet. And this pre-budget worksheet is just kind of a synopsis of where the county is and what direction the county might be going, and is the information that the Department of Local Government Finance needs when they are preparing those certified cap loss revenues to you. That pre-worksheet asks you if there's any new debt that you anticipate in the ensuing year. Are you going to be adding a CUME fund? Are you going to be changing your CUME funds? And it's just a synopsis of what you think you're going to be doing in the ensuing year so that they can better calculate those cap losses. We then have the current year financial worksheet, and this is one that's filled out that shows it's just kind of a synopsis of beginning appropriations for a year, less the expenditures, any additional appropriations you might be doing in the second half or reductions to appropriations in the second half, the amount of property taxes you expect to collect, and the amount of revenues that you expect to collect in the second year. The Form 1 is one that every department head should be filling out for their department. It is, in fact, what you need, what you feel you need for your department to operate on in the ensuing year. And I encourage you not just to look at what was there in the past, but look at what was there in the past and what's actually been spent, and then move forward with your budget. If there's a $5,000 appropriation for, let's say, office paper, and over the past couple of years, you've only spent $2,500, or your predecessor only spent $2,500 each year, reduce that yourself. Reduce that before you go in, so that when you go in and talk to that county council, you can say, I reduced this line item because it wasn't being spent. And so we don't need it here, but I might need it someplace else. So look at what's happened in the past, and you'll have some time to get into this, but don't just put what's there and don't just put an automatic increase on every line item, because when we get to that, or when your council gets to that budgeting process, they're going to need to get it within that maximum levy, and you need to have a voice, or you want to have a voice in what's happening in your office, and make sure that they're aware that you're submitting a budget that you really need to work and operate. Salary requests are handled many different ways in many different counties. But the statutes say there is a Form 144 that is to be completed. It may not say 144 on it, but when you're submitted your information and ask for your salary request on a separate sheet of paper, again, find out what the general consensus of what they think might be going in. Don't just shoot for a highball number. Put it in enough that you get the raise that you want for your people, or it's available there for your people, but try to stay out of the exorbitant way, because again, the budget process is a buy-in from everybody. It needs everybody to work on it so that the council can make the right decisions when they're making their decisions. Miscellaneous revenues are a report that usually the county auditor does the vast majority of work in estimating the revenues, but if you're in a department that has constant revenue coming in, it's always good for the auditor if you will let them know if maybe a special project went through your office this year. So even though it looked like there were a lot of revenues, in a normal year those revenues aren't there. And I talked to the recorders yesterday and gave them an example back many years ago when they were building US 31, and I'm telling my age here. When they were building US 31, when it went through Clinton County, there was a vast majority of right-of-way purchase done, and all of those right-of-ways had to be recorded. So there were over 1,000 recordings that year that were out of the norm, so their revenue was way up that year. So they didn't want the auditor to use those revenues in an anticipation of the next year, because they weren't going to be there. So when you have a special instance like that, or you get a special distribution back, or a refund that you didn't expect, just kind of keep your auditor abreast of those special things. The notice to taxpayer used to be published in the paper. It's now only on Gateway. It's all done on Gateway. And then there are summaries of the budget, Form 4A, Form 4Bs, and Form 4s, and those are forms that are all worked by the county auditor and the county council as they work through the finishing of the budget product. Again, all the documentation is now done in Gateway. The county auditor is probably going to have you submit it to her on paper, but they end up having to put it in Gateway. And that's where the general public, once it's submitted, can see all of the information if they choose to do so. These are some dates that the State Budget Agency and the Department of Local Government Finance have as final dates for different distributions that they're going to be submitting out to you. These are all very important dates and very important revenue sources within the budget process. We talked about this briefly a little bit ago, certified net assessed values. The county assessor must certify those gross values to the auditor by July 1st of each year, and then by August 1st, the county auditor has to have all of those deductions and exemptions applied to those gross assessed values, and then we'll certify the Department of Local Government Finance those certified net assessed values for budget purposes. A county auditor may withhold 2% of that amount for possible appeals and changes that could happen in the last 4 months of the year, because we're way up early in the year. So who does what? Here is the list of the things that the county council does, and when it comes to the budget process, they're really the main wheel in getting the budget process done, because they adopt the budget, they do all of the appropriating, They establish the tax rates and levies for expenditures from all of the funds in the county except a few that are exempted by statute. If it's not specifically exempted by statute, then it must be appropriated. They establish salaries for county employees. They adopt the LIT in those counties that are former Cadgett counties. The county council has control of the LIT adoption. In those counties that were COIT counties, then it's done by the local income tax council, and that's got an error there. The first one should say COIT, the second one should say Cadgett. The PSAP is adopted by the county council, and if the local income tax council doesn't adopt money for the PSAP, the county council has the authority to do that in any county. The same, but for the LIT correctional rehab facilities, the county council has the authority to adopt up to the maximum amount for the correctional or rehab facility of LIT revenue. They adopt the local wheel tax surtax. They approve all additional appropriations and transfers with outside of categories, between categories. They adopt the CCD fund, and they're responsible for the monitoring of tax abatements. So the commissioners, they're our executive body. They do all the purchasing for the county. In some counties they do this, and others they don't, but it does state that the county commissioners should review the salary request and make recommendations to the county council. They receive all bids, they adopt an edit plan, they adopt most of the other cumulative funds, they approve all claims for payment, and then the commissioners should prepare the budgets for, in most counties, the ones that are listed there. In some counties, they may do less, they may do more, depending on how your administration is set up in your county. So the county auditor is our financial advisor. She receipts all of the money into the appropriate fund. She monitors that money by fund. She monitors those appropriations, and she will assist you in ensuring that your appropriations have enough in it to pay your invoice when those come through. She processes all the claims, all county payroll, manages the budget, and does all the data entry into Gateway for budgets. And then she, when the tax collection is over, disperses all of the property taxes, along with, throughout the year, she disperses all of the local income tax dollars. The county treasurer is the custodian of all the money. She receipts all of the money in. She deposits the money daily. She disperses all money, requiring two signatures. She invests the money under a policy with the County Board of Finance, and the County Board of Finance in most counties is the county commissioner and the county treasurer. She is responsible for balancing her cash book to the money that's in the bank. She collects all property and special assessment taxes, and she certifies those collections for distribution in June and in December for distribution out to all the local units. So our revenue streams. Here are some of our revenue streams that we use to fund the county. I think most of you know all of these. Ones that we don't often talk about are the fees for services, which is where I was suggesting those of you who collect the fees in your office make sure that the auditor is aware of anything that might be out change and different. And then interest on investments. Property taxes, the levy may grow by that AVGQ, average growth quotient. And somebody suggested, and I'm going to put this together and possibly mail it out to all of you who are here. Someone suggested that we take these acronyms and make a list of them and have them available so that as we talk about these, you know what we're talking about. And so after the course, I hope that I can put most of them together that you've heard and get them emailed out. So watch for those. The excess levy appeal is an option if you don't have enough money to fund in a current year, but there are very strict stipulations for that excess levy appeal. and it's very difficult. But there are some cases out there where you can appeal and increase your levy for these specific reasons. Levies are collected by fund. They're taxed and collected by fund, and they cannot be commingled between those funds. The CCD is the one cumulative fund that is now exempt from the levy. So the rate that is calculated, that is outside the levy. Debt funds are exempt from the levy. Mental health and mental retardation are adjustments to the levy. And then funds that have specific expenditures are those, can only be spent on those specific items, unlike the general fund is all operating. Vehicle excise is the revenue stream. It's the money that you pay at the BMV when you go and register your plate. It's distributed in June and December out to all the local units, and it's distributed each year by the tax rate. Then here is a list of different miscellaneous revenues that are out there. I'm not going to read them all to you. And then we have our local income tax. This is the fun one. Local income tax has a maximum of 2.5% in all counties except Marion County. It is adopted by the county council in those counties that were formerly the Cadgett County, and it is adopted by local income tax council in all other counties. So if you weren't a Cadgett County, it's by the local income tax council. Now there are a few counties out there where the county council has the majority of the population or the majority vote, and so the county council does adopt it, but in the general sense, it's usually that low at council. The allocation remainder after PSAP and correctional and rehab is reduced, is what is allocated out, and it is allocated between expenditure rate, public safety, and economic development, however you allocate it within your county. You may not reduce one of the different types of lit allocation below what is bonded, what is pledged toward a bond, and the rate remains the same until it's either increased, decreased, or rescinded. Same with the allocations. They remain the same once they're adopted until they're modified or rescinded. Both rates and allocations can be changed once a year. The lit public safety, the lit PSAP is the public safety access point. That is a maximum amount of 0.1%. It's adopted by the county council if the local income tax county doesn't, and it's distributed to the county before the remainder of the expenditure rate. It comes off the top. The lit for correctional and rehab facility was a new one last year. It can be 0.2%, and it is again adopted by the county council. It distributes to the county before the remainder of the expenditure rate. The difference here is it sunsets after 20 years. So when you adopt it, it's only good for 20 years. Doesn't mean you can't re-adopt it, but that adoption's good 20 years. Certified shares are those distributions where in the former Cadgett County, the first 0.25% go to all of the units, including schools, and the remainder goes to what is called certified shares or the different allocations. But that first 0.25% in those original Cadgett counties must go out to all the units, including the schools. This money can be used for all operating purposes. It's usually deposited into a specific fund or the general fund, and the county auditor distributes it monthly when it's received from the auditor of state. That amount is certified from the Department of Local Government Finance in, I think, October 1st or November 1st. Yes.
Can you explain the former Cadgett situation? A lot of talk has been this the last couple of days about former Cadgett County. I'm pretty sure we're a Cadgett County in Marshall, but
No, you can only have one or the other. The original Cadgett counties were ones that took advantage of the opportunity of income taxes when the governor froze the levy back in 1973. And not everybody did that. And then after a while, there were other counties that then decided, gee, we need a local income tax in our county. So the legislature created the Local Income Tax Council for those counties who had not originally adopted Cadgett back in the levy freeze days. So we have lit public safety and we have economic public safety, and they are all a part of that 2.5, and you can allocate them between certified shares, public safety, and economic development however it fits your county best. Can be done annually. One year you may have more in one than the other. Just know that when you change it, you impact those other units and what they're expecting to do. So there needs to be a lot of conversation, and there is some notification that is required. Fire departments do not automatically receive public safety money, but may be added to the ordinance or the resolution that they get a portion of that money. Must be done by the adopting body. On the edit money, those units that get edit money, that edit money comes to the county, but it stays at the county until the county auditor receives an edit plan. If you do not have an edit plan in place, or a local unit of government does not have an edit plan in place, those edit dollars are not to be dispersed out to them. They'll remain in the distribution fund within the county. So then we have our MVH funds, and as we all know, last year was the year, or the year before this was raised, and we had increases in our MVH revenues last year, along with our local road and street. MVH comes directly from the Department of Revenue for the tax on fuel. It's placed in the MVH or the highway fund, and it may be used for salaries, equipment, and maintenance. Unlike the local road and street, it can only be used for maintenance, construction, and reconstruction. Local road and street cannot be used for equipment or for salaries. Local option highway user tax, which we often call wheel tax surtax, comprises the wheel tax surtax, and the county council adopts this and modifies this annually, or can modify it annually. Excise surtax is on passenger cars, motorcycles, and trucks under 11,000 pounds, and wheel tax is on recreational vehicles, buses, semi-trailers over 3,000. I'm not going to read it all to you. It is dispersed monthly by the county auditor to counties, cities, and towns based on road miles and population. So appropriations. Appropriations are not money, but they're the, yes. Sure. More?
No, just right there. So the wheel tax on the recreational vehicles, buses, semi-trailers, are those the ones that are just registered in Indiana, or the ones that a large semi-company has parked on your parking lots around? And
These come from, this money comes from the BMV when they register that plate in Indiana.
okay, so they're registering them in one of their branches in Pennsylvania. We're not able to capture that.
Correct. I believe that's correct. So appropriations are not cash, but they are the authority to spend that cash. And money must be appropriated by the county council except in a few statutorial funds. And I gave you a code site here that you can go out and look at those ones that are common every day. They appear in the auditor's manual, page 814, and it lists those funds. And some of those funds are the incentive funds. The Title 40 incentive funds do not have to be appropriated. The recorder's record perpetuation fund does not have to be appropriated. Some of those funds in that order. Again, as I stated earlier, if it's county money, it must be appropriated unless it statutorily states that it doesn't have to be. All appropriations are always requested by the department or elected official. They're approved by the county council, and they're managed or overseen by the county commissioners. And when I say that, that oversee is the fact that they approve all those claims for payment. So they're overseeing those expenditures of those appropriations. If an appropriation is not sufficient to purchase what you need to purchase, you have a couple of options. The first option is a transfer of appropriation. And if you have there are different categories, and I think I took them out of this slide, but we have different categories, one being personal services, one being supplies, one being other services and charges, and one being capital purchases, capital outlays. If you have sufficient appropriation within categories, you can move that you can request the auditor to move that to cover that invoice without county council approval. But if you're trying to move it from supplies to other services and charges, it requires county council approval. There could be a home rule in your county that you can't move anything without their approval. I don't know of any county that way, but there could be. But under the statute, it currently is within a category is okay, and cross categories approval. If you can't transfer, then you can request an additional appropriation. And when the additional appropriation is needed, there must be a notice of the public meeting published 10 days prior to the meeting, and the adoption must happen in the public meeting. Can't just walk in and say, that's okay, give it to them. Yes. Newspaper. Additional appropriations must be published in the newspaper. So we have encumbrances, and encumbrances are those monies that, or those expenditures that you obligated this year, but it's not going to get through the process until the ensuing year. I bought something in December, I had enough money, enough appropriation to buy it this year, but the bill, there's not time to process it through the claims process. So I can request with that invoice an encumbrance of that money, that appropriation to move forward. It must, the only way that you can encumber, it must be a lawful contract entered before December 31st or an invoice dated prior to December 31st. You must have existing appropriation available. So in other words, if I have a $200 purchase that I made and I only have $100 left in my appropriation, $100 is all I can move forward. I can't move 200 forward. Only the amount required to meet the balance or the remainder of the appropriation can move forward, and the encumbrance can only be spent on that invoice or contract that it's encumbered for. And I'll give you a little brief scenario to kind of explain that. We had a county home that needed a new roof. So in November, we went and we got a quote and accepted the quote, and committed to doing the roof on the county home. Weather turned bad, didn't happen. So we encumbered that money in January from the commitment that we had made, and the weather was still bad. But in February, we decided we didn't want to use that vendor. We could get the roof done for the same amount of money by somebody else that we wanted to use instead of it. Can't do that. You can only use the encumbrance for the invoice or the contract that it's encumbered for. You can't switch. Even though it was for the same purpose, we couldn't change it for the other person. So expenditures of claims. These are kind of responsibilities of what each department head or elected official should do before they take that claim for submission to the county auditor. When they receive their goods, they should put with it a valid invoice, and it should be the original invoice. Verify its accuracy. Make sure that you've received all of your goods before you submit it for payment, and complete the claim voucher attaching that original invoice. You should sign and date it and designate which appropriation you want it paid from. It's not the county auditor's responsibility to decide where to pay it from, which appropriation. It's your responsibility. That all should be completed. Now, there are different ways they do it. Some have electronic claim forms that they fill out, some don't, but it all should be completed by you, because by the time it gets to the county auditor, it's the county auditor's responsibility to audit that claim. And it's a double check to make sure that they're going to recheck and make sure that everything's there, no sales tax are on it, no penalties have been applied. It's got the original invoice, comparing all of the amounts, making sure the amounts inside meet what's on the outside. Once they've verified that claim, they'll stamp it with their approval, and they'll prepare a docket for the Board of Commissioners. The Board of Commissioners then will approve it. Once upon they approve it, the county auditor then will issue the checks. They don't issue checks before the Board of Commissioners, because it happens Board of Commissioners might pull a claim. So the Board of Commissioners, while the county council establishes those appropriations, the Board of Commissioners kind of monitor it, as they have the responsibility to make sure that that's a legitimate purchase from that appropriation. The docket must be received in a regular scheduled meeting or an advertised meeting, a noticed meeting. It must list the vouchers that have been audited and certified by the county auditor, and all the requirements are met. They have the option of reviewing any invoice or any claim submitted for payment. The Board of Commissioners have the authority to deny a claim for payment that they feel needs further verification. But once they've passed that docket and agreed to that, then those are going out the door. You can't come in at the next meeting and say, gee, I wished I hadn't have done that. You need to pull that back. It's too late. Once the Board of Commissioners approve it, it's approved. The Board of Commissioners do have the right to audit all county funds. So where can I learn more about all of these processes? If you want to know where the financial straits of your county are, you've got your county budget order comes out, and now it's coming out in December, and all should be out by December 31st. It can be found out on the Department of Local Government Finance's webpage. And if you go there and you go to county specific and pick your county, if the budget order is the top thing in the county specific data. You can look at the fund report on there to see what was allowed for appropriations, what the county is expecting in revenue, and the levy, what the civil maximum levy is, any changes and additions, and where your cum rate calculations are when they may adjust a little bit. That is all found on that budget order. You have your county annual report that tells you a synopsis of last year, of what was brought in, what was spent by department, the revenues by department. All of your property taxes show up in your county abstract. This is a huge document, and in fact, I'm not sure they still print them, but a lot of the systems can print the abstract sections from their tax software, but it shows what is being calculated and charged to the taxpayers for each of the funds within the county, the schools, the townships, the libraries, and the cities and towns, all the assessed values. It's a huge synopsis of the property tax beginning collection. You have your monthly financial reports that the Board of Commissioners should be receiving from the county treasurer monthly. You can always ask the county auditor for an appropriations report to show where the appropriations are. Is somebody overspending their appropriations? Are they going to make it to the end of the year? That's all shown on that. And then out on the State Board of Accounts websites, if you go to manuals, you can look up the different manuals, and there's one out there for county, there's one out there for auditors, there's one out there for treasurers. Some of them are a little outdated on some of the issues, but the vast majority of the information in there is still correct. Just when you read it in there, you might have to look, if it's something you're questioning really highly, you might have to see if that statute has been updated, and the manuals often have statute in them. So, does anybody have any questions? Because that's kind of the end of mine. Yes?
How often does the capital improvement plan need to be filed for edit?
The edit plan must be created every year. Even if they make no changes to it, they should readopt their edit plan and submit it to the county auditor every year. Okay, so I want to encourage you to follow us, as you've seen earlier, on all of our web pages. And if you have any questions, I'll be around for the next day and a half, and you're welcome to call me or email me at any time. We are now going to ask the vendors to come in and give their door prizes. And